Hello, friends. I hope all of you are fine. So, now continuing to this last lecture on this one, on the chapter 2 of the CA material on the financial instrument. Okay, so, right now we are having only the two portions left. One is the reclassification, and then another one is the impairment. Okay, so reclassification of the financial asset and the financial liability as per the Ind AS 109. An entity shall classify the financial asset. Just a minute. Yeah. An entity shall shall reclassify the financial asset only if the entity changes its business model for managing those financial assets. Okay, just quickly, I am just making it here one um, snapshot relating to the reclassification, so then it will be easy for you to understand. Yep. Okay, just I prepared this table. So in the interest of the time, so okay, if you see this one, so amortized cost. So amortized cost. So here from amortized cost to FETPL, you are reclassifying it, correct? So amortized cost to FETPL and similarly amortized cost to FEOC, you are doing the reclassification. So you are transferring from the amortized cost to the FETPL, amortized cost to the FEOC, and here the amortized cost to amortized cost, it is remain the same. So nothing is coming here. So that's why. So this diagonal, if you see, nothing is here in between. Like similarly here also FETPL, you're reclassifying to the amortized cost. FETPL, you're reclassifying to FEOCI. And here from FEOCI to amortized cost, FEOCI to FETPL. Okay. So at a high level, so when the asset is valued at the amortized cost, so that means it is not, there is no fair valuation is happening in the subsequent recognition. Okay. So here uh, the focus point is that you on the reclassification, uh, you need to bring it to the fair value. So that is the focus point here. So if you see from amortized cost to FETPL, because FETPL it is also valued at the fair value, correct? So here whatever, like suppose here uh, some difference is there, like from the amortized cost to the fair values. So here if it is mentioned here, remeasured at the fair value, and whatever the difference it is there, so gain and loss, it will be transferred to the P&L. So we will be doing the example here also, like suppose, okay, just I will be doing one example here. So say amortized cost is your rupees 80, okay, and at the date of the reclassification your fair value is say 110. So now on the date of the reclassification you need to bring that asset at the fair value, so whatever the difference it is there of 30. Okay, 30. So that you will be transferring it to the P&L. So the entry will be, so to amortized cost, the fair financial asset at the amortized cost that is going out, and you will be debiting fair value this financial asset at FVTPL, and then whatever the difference is there that you need to transfer it to the P&L. So here the profit is there, correct? So 110 will be debiting, and here we'll be crediting 80, and then 30 is your balancing figure which will be transferred to the P&L. Okay. So similarly here from amortized cost to the FAOC also you need to do the same thing. First you need to remeasure at the fair value, and whatever the difference it is there. Okay, like here the 30. So that instead of P&L you will be transferring it to the OCA because this is FVOCA. So whatever the mark to market is there that you are transferring it to the OCA. Correct. And in the FVTPL, so like from the beginning you are measuring it at the fair value, so there is no need for like doing anything. So as it is, whatever the value is there at the remeasurement date, so that fair value you will be continuing and you will be now classifying it under the amortized cost. So here the entry will be like whatever the value it is here. So here in the same example, so at the FETPL you will be valuing at the 110. Okay, and from 80 to 110 whatever you have done before the measure remeasurement, means sorry, before the reclassification, that you will be transferring it to the P&L. So the entry before the classification, before the reclassification, it is that financial asset at FVTPL to P&L you have done it. Correct. So 30 you have taken it. So at the reclassification, so whatever the value is there, so here it will be 110. So same value you will be continuing in the amortized cost. So this example also we will be doing it, but yeah, so this is the same logic. So similarly, like here, as such, nothing is there in between because in the FVTPL itself, you are measuring at the fair value, correct? So the same value you will be continuing for the new reclassification. So for the amortized cost here, from the FVTPL to amortized cost, the new value, the new carrying amount for the amortized cost will be 110. Similarly, when you are reclassifying from the FVTPL to FVOCI, then the value will be your the new value will be your 110. Okay, so just I'm writing the entry here also. So here, continuing with the same example. So what will be the entry for the amortized cost? The financial asset at amortized cost you will be debiting, and you will be creating a financial asset at FVTPL. Correct. So here the value will be 110 it will be. Okay. So similarly, uh, when there is a reclassification from FVTPL to FVOCI, so the entry will be financial asset at FVOCI to financial asset at the FVTPL 110. Okay, because here the valuation is already happening at the fair value, so that means there is uh, no change, no impact on the PNL, or similarly no impact on the OCI. Correct. So this is very straightforward, this one. And in the FVOCI, so here the focus point is when you are doing the reclassification from FVOCI to the another category, like to the amortized cost or to the FVTPL. So whatever the balance is there in the OCI, so what we, so how, so there the focus point is whatever the balance is there in the OCI, so what is to be done with that balance? Okay. So similarly here also the example which we have continued, so rupees 80 here. So from 80 it is moved to 110, correct? So what entry you must have posted if in the FVOCI? Financial asset at FVOCI to OCI, correct? 30. And then the balance in the financial asset at the OCI it will be 110. So now the focus point is what is to be done with this balance. So on the date of the reclassification from the FVOCI to amortized cost, so whatever the balance it is here, this 30, so it will be transferred to the amortized cost carrying amount. So okay, so the entry will be FV financial asset at amortized cost, that is currently it is 110 on the date of the reclassification, to financial asset at FVOCI 110, correct? Then whatever the balance is there, this is the OCI balance. So OCI you will be debiting because it's a credit because there is an increase in the fair value to financial asset at amortized cost. This 30 will be there. So when you combine both the entry, then the financial asset at amortized cost will be 80. So going back to the original price. So had it been like from the beginning, uh, this asset is classified at the amortized cost, so then the value will be would have been 80. So this is what the fund of this one. Similarly, um, when you're reclassifying from the FVOCI to FVTPL, so the same thing. So here instead of amortized cost, it will be FVTPL. So financial asset at the FVTPL 110 to financial asset at the FEOC, and then the OCA balance you will be transferring it to the PNL. Here you will be transferring it to the PNL 30. That's, so here the financial asset at the FVTPL will be shown at 110. Yep. So this is what it is written here. So OCA balance is transferred to the opening balance of the amortized cost, and in the case of the FVTPL, OCA balance is transferred to the PNL. Yep. So I think this is very straightforward. Okay, and here one more thing. So whatever the effective interest there uh, in this amortized cost, so this will be continued as it is. Okay, so here the original effective interest will be same as it is, no change in this one. So overall, like means in the reclassification, it is not impacting your effective interest rate. So similarly here also your original whatever the EIR is there was there for this FEOC, the same it will be continuing here also. Correct. But in the FETPL there is no use of the EIR, so there no need to focus on it. Yep. So just quickly we will be reading. So as per Ind AS 109, an entity shall reclassify the financial asset only if the entity changes the business model. Yeah. So this reclassification it is happening only means it's very stringent means you cannot do the reclassification on a daily basis. It's a very stringent thing. So it it can happen only when you are changing the business model. Then only this class reclassification is happening. So it's a very special situation in which you can do the reclassification. Okay, so only in the case of the business model is getting changed, then only you can go for the reclassification. So such changes are expected to be very infrequent. Yeah. Such changes are determined by the entity's senior management as a result of the external or the internal changes and must be significant to the entity's operation and demonstrate to the external parties. Accordingly, a change in the entity's business model will occur only when an entity either begins or ceases to perform an activity that is significant to its operation. For example, when the entity has acquired or disposed of or terminated a business line. So, so like it has given the example like the business model where you are selling some your business. So then reclassification can come into the picture. So it's a very rare situation. Yep. Okay. Example of a change in the business model includes the following. An entity has a portfolio of the commercial loan. So now it is giving the example. So an entity has a portfolio of the commercial loan that it holds to sell in the short term. That it holds to sell in the short term. So in the short term means your it's a FVTPL. Correct? That is for the trading purpose. So the company, the entity acquires a company. So now it has acquired a company that manages the commercial loan and has a business model that holds the loan in order to collect the contractual cash flow. That is a CCF. The portfolio of the commercial loan is no longer sale. So that means you are changing from FVTPL to your amortized cost. Yeah. So the and this is because when you have acquired one company, so now you have transferred those loans, commercial loan, which was you were directly managing. Now this company, the company which you have acquired, so that it will manage, and this new company it is having a business model of to collect the CCF. That is the SPPI, the interest in the principal. So the portfolio of the commercial loan is no longer for the sale, and the portfolio is now managed together with the acquired commercial loans, and all are held to collect the contractual cash flow. Yeah. So from the FVTPL to amortized cost. A financial services firm decides to shut down its retail mortgage business. That is, business no longer accepts the new business, and the financial services firm is actively marketing its mortgage loan portfolio for sale. So, like the retail mortgage portfolio, it there like you have given the loan to the retail for the housing something, yeah. So it is maybe it can be for the there the business model is to collect the CCF, that is your principal and the interest. But now you are planning to sell to sell this you're you're now planning to sell this business, the retail business. So uh, that means you are just changing your business model from the contractual cash flow to to the sale, correct? So held for sale. So that means you are changing from the amortized cost to FVTPL. Okay, accounting for the reclassification of the financial asset. So this is what I've explained you. So just quickly we will go through. It's very straightforward and easy. A change in the objective of the entity's business model must be effected before the reclassification date. Okay. For example, a financial service firm decides on 15th Feb to shut down its retail mortgage business, the above one, the above example, and hence must reclassify all the affected financial asset on the 1st of April. That is the first day of the entity's next reporting period. So the entity must not accept the new retail business or the otherwise engage in the activity consistent with its formal business after the 15th Feb. So the takeaway is a change in the objective of the business model must be effected before the reclassification. So that if you are planning like means in this one that you are selling the retail mortgage business, so that means and that is you have decided on 15th of February. So then after 15th of February, there should not be no new retail mortgage. Means you should not give any new loan to the customer, like for the housing loan. Yeah. So if an entity reclassifies any financial asset, it must do so prospectively. Yeah, so it cannot be retrospectively, it will be prospectively. Prospectively means from the date when you have decided. So here it's from the 15th Feb onwards. Okay, it cannot be retrospective. The entity shall not restate any previously recognized gain or losses, including the impairment gains or losses or the interest. Yeah. So following are not the changes in the business model. So these are the this is what means I've told you like the business model if change is there so then only and that is also very rare. So here it is giving the example that if something is changed so it's not an example of the change in the business model. A change in the intention related to a particular financial asset. So normally the business model it is applied on the portfolio, correct? It's not applied on the one particular financial instrument. Even in the circumstances of the significant changes in the market condition, the temporary disappearance of a particular market for the financial asset. So if there is some a turmoil in between, but that is a temporary resource. So this temporary situation you should not consider it as a change in the business model. It transfer of the financial asset between the parts of the entity with a different business model. So within the entity, if you're transferring like from one segment to the another segment, so it's not a change in the business model. Okay. So following changes in the circumstances are not the reclassification and an item that was previously designated and effectively hedging the instrument in a cash flow hedge or the net investment hedge no longer classify as such. So the designated, which I was just telling you, if you have opted for the irrevocable option, so then you cannot go for the reclassification of it. An entity becomes a designated and the effective hedging instrument in a cash flow hedge or a net investment hedge. An item becomes a designated and effective hedging instrument. Okay. So it was previously and it is now you are designating it. A change in the measurement of a financial instrument if the entity takes a credit derivative that is measured at FVTPL to manage the credit risk for all or the part of such financial instrument and consequently the underlying financial instrument is also designated at the fair value through P&L. So designated. Yeah. Okay. So here what it is saying, this is talking about the accounting mismatch. This thing. Yeah. A change in the measurement of the financial instrument. So like suppose you are having a loan as an asset. Okay, on that you are having a credit risk because you have given the loan to the customers, various customers. So now So from that customer that the credit risk is there, correct, for the and uh, to mitigate that credit risk, the entity has entered into the credit derivative, like the CDS, credit defaulted swap. So, and normally the derivatives you are accounting it at the FVTPL. Okay, and before this credit derivative, you were doing the accounting of this loan at the amortized cost. So now, when you have entered into the CDS later on, after some time, because there was a fall in the credit risk, means there was an increase in the credit risk, then you have entered into the CDS later on, not at the inception. So then now this accounting mismatch is there. So now you are changing this loans amortized cost to the FVTPL. So this is it was talking about the change in the measurement for the financial instrument. The financial instrument is your loan. If the entity takes the credit derivative that is measured at the FVTPL, fair value through profit and loss, to manage the credit risk of all or part of such financial instrument, and consequently the underlying financial instrument means your loan is also designated at the FVTPL. Yep. Now the financial liabilities are not permitted to be reclassified. Yeah, financial liability, you cannot do the reclassification of it, which I've told you earlier also. This is a reclassification concept. It is applicable only for the financial asset. So now they are giving the example. So these are very straightforward. So like amortized cost to the FVTPL. So what I have told you, so amortized cost to the FVTPL. So here you are valuing it at the amortized cost. That means at the carrying amounts. So on the date of the reclassification, you need to bring it to the fair value. So whatever the changes are there. So like from 80 to 100, which I was 80 to 110. So whatever the changes are there, 30, so this you will be classifying it under the P&L. So this is what they are saying. So it is measured at the fair value on the reclassification date, and any gain or loss arising from the difference between the previous amortized cost of the financial asset and the fair value is recognized in the P&L. So bonds for 1 lakh reclassified as FVTPL. The fair value on the reclassification is 90,000. So before the reclassification, the bond is shown at the amortized cost. So its amortized cost is 1 lakh. So now on the date of the reclassification, its value has become 90,000. Yeah. So bond at the amortized cost is 1 lakh you will be crediting, and then the bond at the FVTPL you will be debiting by 90,000, and this loss on the reclassification, that is because FVTPL it is there, so P&L. So 10,000 you will be taking as a loss on the date of the reclassification. So this is very pretty straightforward. Yeah. So this is like you are removing the bond at the amortized cost, and now you are bringing the bond at the FVTPL, and then whatever the difference is there in the value, so that you are transferring it to the P&L. This is what it is mentioned here. So this is what also we have discussed. Now the amortized cost to the FVOCA. So similarly here, instead of the P&L, it will be your OCA. Yeah. So it is measured at the fair value on the reclassification date. Any gain or the loss arising from the difference between the previous amortized cost of the financial asset and the fair value is recognized in the OCI. Okay, and the effective interest rate, yeah, and the effective interest rate is also coming into the picture. So here this the effective interest rate on the date of the reclassification you need to calculate, and the measurement of the ECL are not adjusted as a date of the reclassification. Yeah, sorry, because here it's amortized cost. So the whatever the effective interest is there, so this you will be taking as it is for the FVOCI also. Yep. So this is what Miss I told you earlier also. There is no impact on the effective interest rate. So bond for the 1 lakh reclassified as a FVOCA, fair value on the reclassification. This is the same example. So here instead of the P&L, it will be your OCS. That is a change here. And this amortized cost, you are not valuing at the fair value. I believe this you know, correct? This we have discussed a number of times. But on the reclassification, you need to bring it at the fair value. Okay, so FVTPL to the amortized cost. So it's a very straightforward. So means you are valuing already at the fair value. So Specially means on the date of the reclassification, you will be continuing as it is. Yeah. So it is measured at the fair value on the reclassification date. This fair value becomes the new gross carrying amount. Yeah. New gross carrying amount, and effective interest rate is computed based on this new gross carrying amount. So here you need to calculate the effective interest rate because in the FETPL you are not having this effective interest rate concept. Yeah. And this effective interest rate you are calculating on the basis of the new gross carrying amount, that is the fair value on the date of the reclassification. So any gain or the loss arising from the difference between the previous amortized cost and between the previous amortized cost of the financial asset and the fair value is recognized in the profit and loss. So it will not be there because you are already valuing it at the fair value. Yeah. So this point is of no use. This one. So bond for 1 lakh reclassified as the amortized cost. The fair value on the reclassification is 90,000. Yeah. So what they've done. So okay. Let me tell you because this is a little bit confusing. So like suppose the reclassification it is happening here, correct? And the asset was purchased on this date, say on 1 X1, and you are doing the reclassification on 30th of March X. So whatever the difference, like whatever the mark to market is happening here. So here, like from 1 lakh, it has gone to 90,000. So it's a FETPL originally. So that means here what you have done. So you have booked the entry at financial asset at FETPL to cash, correct? 1 lakh. And now during this period, so it has gone down the value. So what entry you would have post, posted? PNL to financial asset at FATPL, 10,000. So by this date, your financial asset at the FATPL, it must be coming at 90,000. Yeah. So now this you need to transfer it to the here you are doing the reclassification at the amortized cost. On this date, the reclassification is happening. So what entry you will be posting? Financial asset at FVTPL 90,000, 90K, and financial asset you will be debiting to the financial asset at the amortized cost 90. So this is what you will be doing. So they have combined this entry. If you see this one, they have combined this entry, but logically it should not be combined. Yep. Similarly, FETPL to FEOC, it's very straightforward. So whatever the fair value it is there on this one, so instead of here amortized cost, here it would be coming at FEOC, financial asset at the FEOC. So here also they have combined this entry. If you see, 90,000 you have debited, bond at the FEOC, bond at the FETPL 1 lakh, and 10,000 on the so this so they have combined this entry, this thing. Okay, now coming to this one, so FEOC to amortized cost. So this what I have told you, like means whenever you are doing the reclassification from the FEOCA, so the focus point is your OCA balance. Yeah. So here this OCA balance, it will be getting transferred to the opening gross carrying amount. So the financial asset is measured at the fair value on the reclassification date. Yeah. However, the cumulative gain previously recognized in the OCI is removed from the equity and adjusted against the fair value of the financial asset at the reclassification date. So that means you are transferring the OCI balance to the amortized cost, the opening balance of it. Yep. As a result, the financial asset is measured at the reclassification date as if it had as if it had always been measured at the amortized cost. So this is making sense. Like means it is looking like originally means that you would have originally you have done the classified at the amortized cost. So this is what they are trying to say. And the effective interest rate it remains same as it is the original effective interest rate. Yeah. And the expected credit loss are also not adjusted as a result of the reclassification. So this is it is talking about the loss allowance. The bond for 1 lakh reclassified as the amortized cost. Fair value on the reclassification is a 90,000 and 10,000 loss was recognized in the OCI. So this is what they are doing. So the same entry is a bond at the FEOCI 10,000 to OCI loss. Yeah, OCI loss and the bond to bond amortized cost to the FEOCI 1 lakh. Just a minute. So bond for 1 lakh reclassified as the amortized cost. The fair value on the reclassification is 90,000. Okay. So so this should be your 90,000 because your fair value is the on the date of the reclassification is 90,000. Yeah. So it should not be 1 lakh. It is to be 90,000 and then okay. Just a minute. What they have done? No, 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 no. Wait, wait, wait. Okay, so what they are doing, so first they are transferring the OCA balance to the bond at the FEOCA itself. Okay, this is what they are doing. So they are just reversing the OCA balance and then they are transferring it to the bond at the FEOCA. Okay, and then they are transferring from the bond at FEOCA to the amortized cost. So it can be the other way around also, like bond at amortized cost to bond at FEOCA and OCA, whatever the loss is, it is there. So this will be your 1 lakh. Okay. And the bond at the FEOCA, it was showing at the fair value 90,000 and the balance, not the balance. And in the OCA, you were having a loss of 10,000. So this loss you will be transferring it to the bond at the amortized cost. Yeah. So this is the actual entry. This is the more correct entry. Yep. Okay. The financial asset continues to be measured. So now it is talking about the FEOCA to the FETPL. So it's a straightforward. So whatever the OCI balance will be there, the loss you directly will be transferring it to the P&L. So here the entry should be bond at FATPL to bond at FAOCI 90,000, 90,000. Okay, and the second entry to make the OCI balance zero to OCI 10,000 and you'll be transferring it to the P&L 10,000. So bond for 1 lakh reclassified as the FATPL, the fair value of the reclassification is 90,000. Yeah. So P&L, so P&L on the reclassification 10,000. So here this the bond should not come here. Yeah, so here it should be coming OCI. So bond at the FETPL to the bond to FEOCI. Yeah, so this is the same thing. Yep. So the financial asset continues to be measured at the fair value. The cumulative gain or loss previously recognized in the OCI is reclassified from the equity to the profit and loss as a reclassification. So here the one catch point is uh, had it been the equity instrument you have designated at the FEOCA. So then there cannot be a reclassification of this OCA balance. Yeah, you cannot transfer it to the P&L. So that is a non-recyclable. Now coming to the impairment. So this is a very important topic. Uh, and this is like if you want to make a career in this impairment of this financial instrument. So here in the banks, so they are having a dedicated division also for this thing. So this is very important topic, but I think because in this lot of practical experience is required, but I think in the CA Institute material they haven't done the deep dive because in this the practical exposure is required in this one. Yeah. So wherever like means I will be just reading this thing line by line, and then wherever I find it, so then I will be just giving you some additional information with the help of the practical uh, thing. Yep. Okay. So scope of the impairment. So now it is talking about the where the impairment can be done in on which financial instruments. So an entity shall recognize a loss allowance for the expected credit loss. So expected here it is talking about. So expected. So one thing. Um, so you should know the meaning of this expected here. So that means the loss allowance for the expected. So it's like a provision. Okay. So okay. Uh, so you must be knowing about the debtor, the receivables concept. So in the debtor, uh, whatever the debtor you are having, like suppose you are having a debtor of say 60,000, correct? And this money you will be receiving say after some time. So like means say after the 3 months you will be receiving it, or maybe just take after 2 years. Okay, so this is a big time. So 60K you will be receiving here, and you are standing here. So so you are thinking maybe like first you have recorded at the 60,000. Just I'm ignoring the time value of money concept here. Otherwise, you need to uh, make it at the present value because of the significant financing component here because of the 2 years. Yeah. So just I'm ignoring the time value concept here right now. Um, so the 60,000. So and suppose in the beginning, so it's okay. Like means it's a good debtor, but after some time, like means when the 1 year is over, so then you are little bit skeptical about the debtor. So its credit risk has increased. So all those things. So now you are thinking to create a provision. So for the provision, what you are passing the entry profit and loss to provision for bad debts, correct? Or maybe you can call it as a provision for doubtful debts. Provision for doubtful debts. Say it's coming 10,000. You have created the provision. Okay. If you see here, you haven't credited the debtor. That is a catch point here. Okay. You are not crediting to the debtor. So till now, the debtor isn't impaired, hasn't impaired. Correct. And say suppose after 3 months further, after 3 months further, okay, so after 3 months here, uh, the debtor has become impaired. So then whatever the end, now you are able to recover only here, say 40,000. So what the entry you will be posting here, cash account to debtors, or maybe just a minute. First you will be what you will be doing, provision for bad debts you will be debiting 10,000. Okay, just make it 45,000. Otherwise the amount will be same. Okay, and to debtors you will be reducing by 15,000. And whatever the difference is there, that you will be transferring it to the P&L 5,000, and then cash account to debtors 45,000 you will be doing it. Yeah. correct? So here on the impairment, when the credit that impairment happens, actually that the default event happens, so then you are deb- then you are reducing your debtors balance. Okay, and before the default happens, you are just creating the provision. You are not uh, reducing your debtors balance. Yeah, so I think you know this thing because this you know from your childhood. So just I thought that I should start with this concept, then it will be easy for you. Yeah. So in the impairment, so here the three stages are there. First stage, second stage, third stage. So this is in the IFRS world. Okay, and in the US GAAP, directly the third stage is coming. So they are having a more stringent rule for this thing. Uh, Sorry, not the first stage, only the second and the third stage are there in the US GAAP, not the first stage. So in the first stage, you are having a 12-month ECL is there, and here lifetime ECL is there, and here it's a credit impaired. So here also the lifetime ECL is there. Okay. So ACL full form is expected credit loss. So and here the 12 month is there. So in the 12 months, so here in the first stage and the second stage, till the end of the second stage, you are creating the provision. Simple. So you are not touching you are not reducing your the financial asset balance. The same thing. Okay. And in the third stage, when the credit impairment happens, so then you are reducing the financial asset balance. So this entry you will be passing in the third stage, and in the first and the second stage you will be passing this entry. Yep. Okay. Now coming to the 12-month stage. So what is the meaning of the 12-month there? So suppose your instrument life is say 3 years, the loan you have given. So this impairment it happens on the financial asset, not on the financial liability. Yep. So the bank has given a loan for the 3 years. So 12-month ECL, and now you are standing at the inception. So from the inception, you need to create the provision. Okay, even if you are valuing your loan at the inception at the fair value, then also you need to create the provision. So this IFRS is conservative, so that's why it is creating the provision. So this is a big change here. Earlier it wasn't done. So in spite of valuing at the fair value, then also you need to create a provision here. So now if you are standing here, okay, 1 year, 2 year, and 3 year. So this is life of the loan. So in the 12 month, what is there? So whatever the default event is there, which you can think. So the default, say suppose your default event is like it can be various default events can be there. So just for the simplicity, so when you have given the loan to a customer, so to a company, say, so at that time, so the rating was triple A. Okay, and my and as as per the bank, the default event arises when the this credit rating of the company it goes down. Means the company means to whom you have given the loan. If it goes down to D, so then only this default happens. This credit event occurs. Yep. So so now you need to predict. Means the bank has to predict at the inception that what is the probability that the loan which it has given to a company, its rating will go down from triple A to D or below in the upcoming 1 year. So this is what. So this is the process. So here you are predicting the probability of default in the 12 month. Okay, and in the lifetime ACL, the same default event. What is the probability of that the company's credit rating goes down from triple A to D during the 3 years. So this is a lifetime year. Okay, so here the PD will be higher, of course, because here your time period is more. So the time period to have the default event, so that is more. So that's why your PD will be more. But here your time period is less, so the default event, the occurrence of the default, it will be less. So the PD will be less here as compared to the PD. So that's why. So in the first stage, your 12-month ECL, the 12-month PD will be low, but the PD means your probability of default. Okay, and the ECL formula is mainly it is instrument by instrument. It is PD into LGD into EAD. So like here, suppose the bank has given a loan of say rupees 1 lakh. Okay, and if the default happens, like means the credit rating goes to D, so then the default is happening here, and then the bank is expecting that the recovery is say 60%. So that means out of 1 lakh you can recover, the bank can recover 60,000. So but 40,000 is gone, correct? So your EAD exposure at default is means the what will be the exposure uh, at the time of the default. Okay, so here it's a 1 lakh just for the simplicity. Then your recovery is your means you cannot recover the 40,000. So that means your 40%. So this is your 40,000 it is coming. And what is the probability of default that the default will occur in this 12-month period? So it is a 1%. So then your ECL will be your 40,000 now. So then it will be 400. So for this 400, what you will be passing the entry PNL to loss allowance. So loss allowance is the another name of the provision for doubtful debt. So it's a provision. So this is for the amortized cost. You will be following this type of entry. Yep. So I hope it's clear. So this is very basic thing. So you should understand about it. Yep. Okay. So now quickly coming to this one. So an entity shall recognize a loss allowance for the expected. So now you can understand why they have used the word expected here. So here there is a movement from the incurred loss model to the expected loss model. This one. Because in the stage one and stage two, you are creating a provision. And then in the third stage, also once the impairment happens, so then also you need to create the ECL, expected credit loss for the further period, like if the instrument life is a 5 year. Yep. So if an entity shall recognize a loss allowance for the expected credit loss on the following: the financial asset that is measured at the amortized cost, a financial asset that is measured at the FVOCA, a lease receivable, the contract asset or a loan commitment, and a financial guarantee contract. So these are also the new things. So on the commitment also, the commitment for this like the bank has given a commitment that you can take the loan during say 2 years at any time of say X amount. So this you can take it. So this is a commitment which the loan has given, which the bank has given, and the financial guarantee, which I explained you in the last lecture also. So on this also you need to create the provision. Yeah, and on the lease receivable also. So in the lease receivable means, so on the lease, this one like you have given one asset on the lease, say on the you have given a machinery on the lease for say 3 years. So now for the 3 years you will be receiving the amount from the lessee, correct? So you have already given the machine to the lessee, but now in the installment you will be receiving the cash from the lessee, correct? So now, so there is a possibility that the lessee can default. So for that thing, you need to create a provision. See, see for the transaction between the lessee and the lessor, the lease particular accounting standard is applicable. That is the Ind AS 116. But for the impairment of this one, on the impairment of the lease amount, for that thing, you need to apply the Ind AS 109 here. Yeah, I think this I have explained you in the chapter one also when we were talking about the descoping. Yeah. Okay, just I'm giving one a quick example. I was just thinking, so because this I prepared, so maybe quickly we will go through. Um, okay, so like suppose here a bank has given a loan. A bank has given a loan to XYZ Limited of rupees 10 lakh for 4 years at say 7% per annum and the market interest rate is 10%. This loan is classified as the amortized cost and the FEOC. So I'm just giving you example from the amortized cost and the FEOC point of view. Yeah. So at the end of the first year, uh, so so here in the just for the simplicity, I haven't taken it at the inception. You're creating the loss allowance. So directly, I'm just taking the example that the loss allowance we are creating at the end of the first year. Yeah. So at the end of the first year, your fair value is 9 lakh, and at the end of the at the end of the first year, the fair value is 9 lakh. Yeah, and at the end of the first year, your this life your this thing. Sorry, this one the 12-month ECL. 12-month ECL is 1% and the LGD is 40%. Yep. So first step here for the amortized cost and the FEOC, you need to calculate the um, present value. Correct. So see, so 70,000 how it is coming? So 1 lakh, sorry, 10 lakh into 7%, that is a coupon, so 70,000. And the time period it is for the 4 years, so 70,000, 70,000, 70,000, 70,000 for the 4 year. And then at the end, the redemption it is happening at the 10 lakh only, at the par. So, and you will be discounting at the 10% here. So then the PV it is coming 904,904, which is less than your 10 lakh, which is also making sense because your discount rate it is more than your coupon rate. That is a 10%, it is more than a coupon rate, that is a 7%. Yeah. So first you have calculated the PV here. Now the loss allowance. So for the loss allowance on the coupon, you will be applying the 70,000 is your exposure and the 1% is your probability of default and the LGD is your 40%. So it is coming 280. And for the principal, similarly, instead of 70,000, it will be 10 lakh and then the same it is. So it will be coming your 4,000. So 280, 280, 280, 280 because the coupon you are receiving each year 4 times, correct? Means 4 times you are receiving, that is in each year for the 4 years, correct? 280, 280, 280 and 4,000. So this you need to discount at your market interest rate, that is your EIR 10%, it is coming 3620. So this I am just going in detail because the institute they haven't explained all these things, but yeah, this you should know. Okay, and then this equation, this is your amortization table. So just I've prepared in the form of the equation. Uh, yeah, so 904,904 is your opening balance, and then the interest on the basis of your EIR, that is a 10% you will be calculating on this one, and then the coupon you will be deducting, and this is your gross carrying amount. This is your gross carrying amount. Yep. And then this is your provision which you are creating. Yeah. And this one is your net carrying amount, or you can say the carrying amount. This will be showing in net carrying amount. Yeah. But in the balance sheet, you will be showing this one, and the P&L to loss allowance, you will be uh, passing this entry 3620, this one. Correct. And for the coupon, you will be passing bank account to loan account, and then for the income booking, loan account to P&L, and at the inception, what you have posted, loan account to bank account. So these are very straightforward. Yep. And so here the catch point is that the next year you will be calculating the effective interest rate this one on this balance, not on this balance. But when you are reaching to the third stage, that means it's already credit impaired. So then here whatever the balance is there on this one, the loss allowance you will be charging it to the means you will be loss allowance to that financial asset to loan you will be doing, correct? So then whatever the value it is coming, the net carrying amount. So in the third stage, the interest you will be calculating on this amount. But in the first and the second stage, you will be calculating the interest on this amount in the second year onwards. Yeah. This you need to be clear, crystal clear, because these are the very small, small things. Now coming to the FEOCA, the same equation as it is, 904, 904, then the interest, this one, from till here it is same. Now, whatever the gross carrying amount is, so here the fair value it is coming 9 lakh, which is there in the example. So 9 lakh minus, sorry, 9 lakh 25,394 minus 9 lakh, this is a balance figure 25,000. Yeah. So it's FVOC. So that's why you're what you're doing, what you're passing because it's a loss. So then OCA to loan account you will be doing 25,000. But in this, out of this this loss, you need to transfer for the loss allowance to the P&L. So what you are doing from the PN, from this OCA balance, you are transferring it to the P&L for the OCA. Correct. So this mark to market which is happening here, so it can be due to the, say, due to the two factor, the interest rate, that is your market risk. Okay, market risk, and the another one is the credit risk. So whatever the fluctuation is happening due to the credit risk, for that you have created the loss allowance. So that lo- fluctuation you should charge it to the P&L. Yeah, and for the other one, the remaining one, you you can uh, you will be, you will not be transferring from the OCA to the P&L. You will be keeping it in the OCA. Yep. And in the second year also, so here also you will be charging the interest, this one, the effective interest you will be applying on this one. But if it is the third stage, then not on this one, not on this fair value. So whatever the OCI balance you have reduced from the whatever the loss allowance you have reduced from the loan, so that balance, that is the net carrying amount you will be taking, and on that you will be accruing the effective interest rate interest. Yeah, I hope this is clear, and it's very important thing to understand about it. Yeah, otherwise it's very difficult to understand, because what I have seen in the institute material, they haven't gone so much in depth about it. Okay, so the loan commitment and the financial guarantee contract. See, the example which I have taken, that is for the amortized cost and for the FVOC. This I have taken. So here also, if you see the, in the FVOC, you are doing the fair, you are valuing the asset at the fair value, but then also you are applying the uh, this loss allowance, the ECL concept. So I think that is clear now. If you, that's why miss I showed it in the equation format, that thing. Yep. The impairment model does not apply to all the financial asset that are the equity instrument, because these are measured either at the FETPL at the FEOC. So just remember this thing, that on the equity instrument you cannot apply uh, the impairment model. Yep. And second thing, the FEOCA, here also FEOCA is coming, and here also FEOCA is coming. But in this FEOCA, here you are designating on, means the irrevocable option you are availing, then only the equity instrument can be classified at the FEOCA. And here what you should know, that the OCA balance is is not recyclable. So that's why here the impairment model cannot be applied on this FEOCA, in spite of that it is classified, it is designated under the FEOCA. But for the debt instrument, it can be applied. The on this ECL can be applied. That concept can be applied here. Okay. And the financial asset data, debt instrument that are measured at the FETPL. So FETPL, because it's fair valued, so that's why and their mark to market, it is captured under the panel. So that's why. So here already the mark to market is getting captured, like that the interest rate risk factor and the mark credit risk factor both are captured under the panel. So then there is no need to apply the impairment, this ECL concept here. Okay. Similarly, the FETPL, again they have said the any other financial instrument measured at the FETPL. So this is for your, you can say, the equity instrument. Yeah. And what is the credit loss allowance? So for the financial asset, the credit loss is the present value, which I've told you is the present value of the difference between the contractual cash flow that are due to an entity under the contract and the cash flow that the entity expect to receive. So this is the same thing, that what you are not able to recover. So that thing you need to discount it. Yep. So the contractual original cash flow is your, say, 70,000, here it is there. And what, in my example, the uh, what it was, Sorry, not this one. This one. Yeah. So 280. So this 70,000 minus 280. That will be coming there. So 70,000, 70,000 minus 280. So ultimately, when you are taking the difference of this one and this one, so then the 280 will be coming. So directly I have taken the 280. Yeah. An entity shall estimate the cash flow by considering all the contractual terms of the financial instrument, that is a prepayment, extension, call, and the similar options. So that is your embedded derivatives through the expected life of the instrument. The cash flows that are considered shall include the cash flow from the sale of the collateral held or the other credit enhancement. So if it is collateralized, so then whatever the money you are recovering, that you will be reducing it. So from the exposure, that exposure at default, so this will be reduced. Like this is your recovery, correct? So the recovery, so after the recovery, whatever the unrecovered amount is there, so that is taken care by your LGD. So this is what they are trying to say. So there is a presumption that the expected life of the financial instrument can be estimated reliably. Yeah. So expected life can be presumed. Yeah. So now coming to this one, the general approach. Okay, now coming to the different approaches for the impairment of the financial assets. So the general approach, which I've told you, an entity to recognize at each reporting date an impairment loss allowance using either the 12-month ECL or the lifetime ECL. Okay, so 12-month ECL typically results in the lower impairment since it focuses only on the probability of default within the next 12 months period as against the PD over the life of the instrument. So this I was just telling you. Okay, so so the difference between the 12 month and the lifetime ECL, it's only of the PD. Correct. So EAD and the LGD both remain same in both this thing, the 12 month and the lifetime. So only the changes, only the difference is that is of the PD, the probability of default. So this is what I was just telling you, that in the 12-month ECL you are predicting about the default event which is happening in the next 12 month. Okay, in this one, and in the lifetime you are predicting the default in the lifetime. So that is in my example which I took. So it was of 3 years. So that is a lifetime there. So that in the lifetime that is of the 3 years. Yeah. So the LGD and the EAD, it is not impacted by this in the 12 month and the lifetime. Yep. In both LGD and the EAD remain same. Only the PD it gets changed. And in the 12-month ECL, the PD is less as compared to in the lifetime ECL, the PD is more. The use of the ECL depends on whether there has been a significant increase in the credit risk on the instrument since its initial recognition. Yeah. So how you are moving from one stage to the another stage if there is a significant increase in the credit risk. Yeah. And in the third stage, that event has happened. That is a default event has happened. The credit risk, the default event has happened. Yep. The This approach is applicable to all the financial instruments covered by the impairment requirement. So what are those instruments? Only the financial asset that is relating to the that is classified as FVTPL or FVOCI, the lease receivables, the financial guarantee contract, and the loan commitment. Yep. So this approach is applicable to all the financial instruments covered by the impairment requirement of the Ind AS 109, except the instruments covered in the following two approaches. so, so in this a simplified approach, okay, first we will read it, then I will explain it to you. This approach does not require an entity to track the changes in the credit risk. Rather, each entity recognizes impairment loss allowance based on the lifetime ECL at each reporting date, right from its initial recognition. Okay, so in this approach, directly you are saying that the stage 3 is applicable. That is a not the stage 3. So it's like your stage 2 or stage 3 are applicable. The lifetime ECL you are taking at each reporting date. So normally this is for maybe they have mentioned somewhere. Okay, yeah. So here the lifetime expected ECL is the expected credit loss that result from all the possible default events over the expected life. Default events. Yep. So the example which I took, so in that the default event is moving from the triple A to D credit rating. Yeah. So 12-month ECL loss is the portion of the lifetime expected credit loss that represent the expected credit loss that result from the default events on a financial instrument that are possible within the next 12 months. Okay. So in the simplified approach, you are taking the lifetime ECL. Lifetime ECL. Okay, the application of the simplified approach is mandatory. So this is simplified approach. It is mandatory for who? For which financial instrument product, the trade receivables or any contractual right to receive cash or another financial asset that result from the transaction that are within the scope of the Ind AS 115 having no significant financing component. So this is very important. No significant financing component. So where this significant financing component will not be coming, significant financing means your time value factor. So it is so this time value factor is not coming where you are having the financial asset which is so the like the trade receivable which is you are about to receive from the debtors within less than 12 months. So in that case, you will be applying the simplified approach. Yeah. Okay. And in the POKI, purchase or the originated credit impaired financial asset approach. This approach is applicable to the financial asset which are credit impaired on the purchase or the origination. So normally, like this also I've explained to you. So POKI is the short form is a POKI, purchased or originated credit impaired. So uh, like uh, like in the distress sale, the bank is acquiring a portfolio of the loan or simple loan for in the distress sale at a very cheap rate. So in the distress sale where the default event is already happened, okay, of that loan, and then you are acquiring that asset. So like uh, the banks they are selling their NPAs, correct? So NPAs to the another entity. So that another entity which is acquiring that defaulted loans. So defaulted credit impaired means where the default event has happened. Okay. So only at the acquisition of the default means only at the time of acquiring, only at the time of purchasing the default loan. So on that this approach is applicable. So here you are not creating any provision. Okay, first thing, you are not creating any provision in this one. So I hope maybe if they've explained the POKI here, so then I will explain it to you. But yeah, practically, so on this one, on the POKI, which are credit impaired and you have purchased it. So on that, this the loss allowance is not applicable. The provision allowance is not applicable. So this is directly falling under the stage three. Okay. So what is the 12-month expected credit loss in the lifetime? So this I've already read. Okay, how the entity determine whether it should apply the 12-month or the lifetime ECL. So the decision tree is to be applied in determining whether the entity needs to provide for the 12-month expected credit loss or the lifetime expected credit loss is applied as follows. Okay, so three stages which I was just talking about. So particularly stage one is initial recognition. Credit risk is low, and the significant if there is a significant jump in the credit risk, like in my example, the default events of triple A, or here it's like C. Okay, and here it says D. So if you see there is a significant change in the credit rating, and that is also deterioration. So this is like a significant credit increase in the credit risk here, and this is the credit impaired. So default is like your credit impaired. Yeah, so where the default event has occurred. So this is a one example. Then so the another example is like in the days past due. So the days past due is like, suppose you're expecting that the debtor, okay, so like you are standing here. Okay, you are standing here. So say suppose it's 1st April 2026. Okay, so here, so till, and you are expecting means the debtor has to pay the money by 31st of 30th of April. Okay, within 1 month it has to pay. So this is a due date. This is a due date. And plus, if you are taking this 30 days here, 30 days here, and 30 days here. Okay, 30 days, 30 days, 30 days. So if the debtor hasn't paid, okay, if the debtor hasn't paid on 30th of April, that is on the due date, but then also it is not paying uh, till next 30 days. Okay, so up to till 30 days, here it is. So 30 days is how much? May, June, July. So 31st of July, just I'm taking in the month. Okay, sorry, 30th means your 31st of May. So if the debtor is not making the payment till 31st of May, so that is a 30 days it is. So then till here it is, the debtor is categorized under the stage 1. Okay, and for the next 30 days, further 30 days he hasn't paid. Okay, so here it is coming May, June, 30th of June, and this is coming 31st of July. So here, um more than 30 days, normally it starts falling under the stage 2. Okay, generally. So stage 2 it is, and beyond 90 days, it starts falling under stage 3. So this is also another example. So this is called as the 30 days past due. So short form is 30 days DPD. This is very uh, famous in the impairment. This thing 30 days past due, 30 days DPD. So this is also the another example, the credit rating one. This is what I was just giving you. So this is very easy to understand. And this one is like, if for the debtor, if it is like the debtor is not paying beyond this due date, so then you can classify it on the basis of the days, like till when till what date he hasn't paid. So on that basis, you are categorizing another stage 1, stage 2, stage 3. Yep. So Appendix A of the 109. Okay, so this is done. So ECL. So normally, so this is what like means in the inception you are taking the 12-month ECL, then lifetime if there is a significant increase, and then the lifetime ECL. So here it's a credit impaired. And the interest recognition, this I was just telling you in my equation that the gross carrying amount you will be taking for the interest calculation in the effective interest rate, and here also you are taking the gross carrying amount, and then this is a stringent, so here like you are taking the amortized cost. Okay, that is a net carrying amount. So this I was just This I explained in the example which I framed. Okay, Appendix A of 109 defines the gross carrying amount and of the financial asset as the amortized cost before adjusting for any loss allowance. Okay, and Appendix A of the Ind AS 109 defines the amortized cost of the financial asset or the financial liability as the amount at which the financial asset or the financial liability is measured at the initial recognition minus the principal repayment plus or minus the amortization, okay, of any difference between the initial amount and for the and adjusted for the loss allowance. So this is the main thing. So this is your net carrying amount. You can say the amortized cost this one, and in the gross carrying amount, you are not adjusting the loss allowance. Okay. So determining whether the credit risk has significantly increased. So Ind AS 107 defines the credit risk as the risk that the one party to a financial instrument will cause a financial loss for the other party by failing to discharge an obligation. So now it is telling like how to identify which are the significant increase in the credit risk. So the short form normally it is used SICR, significant increase in the credit risk. So when determining, so defines the credit risk as the risk. So this is a definition of the credit risk. Okay, defines. Okay, so when determining whether the recognition of the lifetime expected credit loss is required, an entity shall consider. So okay, so for the credit for the POKI, you are taking the lifetime expected credit loss directly because there already the event has happened, the default event has happened. Okay, so when determining whether the recognition of the lifetime expected credit loss is required, an entity shall consider the reasonable and the supportable information that is available without the undue cost or effort that may affect the credit risk on a financial instrument. Okay, the expenses should not be incurred heavily. Okay, this is what they are saying for determining the lifetime expected credit loss. The following non-exhaustive list. So it has given some examples of it. Okay, may be relevant in assessing the changes in the credit risk. Significant change in the internal price indicator of the credit risk as a result of the change in the credit risk since the inception include but not limited to the credit spread. Yeah, so this is also the one thing. So credit spread. So credit spread it depends on your credit rating. Okay. So credit spread like the if the this also I've explained you like Adani versus Reliance. If the bank is giving the loan to Adani or Reliance, so then the difference is for the Adani the credit spread will be higher as compared to the credit spread for the Reliance company, but not limited to the credit risk that would result if a particular financial instrument or a similar financial instrument with the same terms and the same counterparty were newly originated or issued at the reporting date. Okay. So the significant change in the internal. Okay. So other changes in the rates or terms of an existing financial instrument that would be significantly different if the instrument was newly originated or issued at the reporting date. So suppose like the if any instrument which is issued to Reliance by a bank 1 year before, and today if the bank is issuing the same financial instrument with the same characteristics to Reliance company again after the 1 year. So if there is a significant changes, so then it will it will give you a hint of SICR. Okay. So other changes in the rates or the terms of an existing financial instrument that would be significantly different if the instrument was newly originated or issued at the reporting date, such as more stringent covenant, yeah, increased amount of the collateral, or higher income coverage because of the changes in the credit risk of that financial instrument. So now in the new loan, if the bank is charging, if the bank is asking for a increased amount of the collateral or the stringent conditions are put, so then it gives an hint for the significant increase in the credit risk. So all these are theory, but yeah, this is very important. Like when you will be moving from the stage one to stage two. Okay. So these are the list here. So just quickly we will read the significant change in the external market indicator. Okay, external market indicator for a particular financial instrument. So changes in the market indicator, the credit spread, the credit default swap, if the CDS is trading in the market, the length of the time or the extent to which the fair value of the financial asset has been less than its amortized cost. Okay, the fair value is less than the amortized cost and other market information relating to the borrower, such as the changes in the price of the borrower's debt and the equity instrument. Yeah, an actual or expected significant change in the financial instrument's external credit rating. So this I was just telling you. Yeah, an actual or the expected internal credit rating. So if the sometimes the bank they are also having their own mechanism instead of relying on the external credit rating like of Moody. Okay, so developed they have developed their own internal credit rating base. So an actual or the expected internal credit rating downgrade for the borrower or decrease in the behavioral scoring used to assess the credit risk internally. Existing or the forecast adverse change in the business, the financial or the economic conditions that are expected to cause a significant change in the borrower's ability to meet its debt obligation, such as an actual or the expected increase in the interest rate or an actual or expected significant increase in the unemployment rate. Okay, so they are like the lot. So now in the current situation, like in the market, so because of the AI, so a lot of the companies uh, they are laying off their employees. So this is another example. So it is talking about the business. Yeah. Now it is talking about the operating result. So an actual or the expected significant change in the operating result of the borrower, for example, the actual or the expected decline in the revenue. So revenue or the profit or operating risk, if it is increased, so working capital deficiency, all those things. Yeah. Significant increase in the credit risk on the other financial instruments. So like the other debt instrument which is means issued to the same counterparty. Yeah. So from there also you are getting a hint that there is a significant increase. And actual or the expected significant adverse change in the regulatory, the economic, and the technology environment of the borrower. So all these are the example, yeah. So significant change in the value of the collateral. So collateral also, like if there is a significant down in the collateral value, so then that is also giving an hint for the SIC here. So collateral supporting the obligation in or the quality of the third party guarantee or the credit enhancement. A significant change in the quality of the guarantee provided by a shareholder, okay, or an individual's parent if the shareholder have an incentive and the financial ability to prevent the default by the capital or the cash infusion. Yeah. Significant changes such as a reduction in the financial support from the parent entity or the other affiliates or an actual or the expected significant change in the quality. So again it is talking about the financial guarantee here. So expected change in the loan documentation, the expected performance in relation to the financial instruments. So all these are just for your knowledge purpose. So just you can read it, yeah. And other the past due information. So 30 days. So this is an example of the 30 days past due. Revertible presumptions. Revertible means your whatever the presumption it is, you are uh, challenging. Correct. So the revertible presumption means uh, so presumption here it is like the as per the standards. So if the 30 days past due it is there, so then it is like your till 30 days past due it is your stage one. Okay, this is what I've explained to you. Okay, so here you can challenge this presumption. You can say that no, even if the 30 days past due it is there, so still your debtor it is not coming under the under the stage two if it is 30 days or more. Correct. So, so regardless of the way in which an entity, so up to the 30 days, as per the standard, it is like up to the 30 days, means less than 30 days, less than 30 days, 30 days. DPD, then it is stage 1. This is what the standard has told, okay? And from more than 30 days or more up to 90 days, stage 2. And more than 90 days, 90 days, 90 days DPD, that is 90 DPD, then stage 3. So here you can challenge. You can say no. In my this thing, in my case, so it is not justifiable. So this you can challenge it. So this is a rebutable challenge. So regardless of the way in which an entity assesses a significant increase in the credit risk, there is a rebutable presumption that the credit risk on a financial asset has increased significantly since the initial recognition when the contractual payment are more than 30 days past due. An entity can rebut. Okay, an entity can challenge this presumption if the if the entity has a reasonable and the supportable information that is available without the undue cost or effort that demonstrate that the credit risk hasn't increased significantly. Yep. So from less than to more than this thing, from moving from stage 1 to stage 2, that is your SCIR. It is there. So it is presumed. So here you can challenge. You can say that no. Even if the debtor's DPD has increased more than 30 days, that is like from the 25 days to 35 days. So then also there is no significant increase in the credit risk. So that you can challenge. That demonstrate that the credit risk has not increased significantly. So like here the example is like you're from say so while categorizing under the stage when your DPD of the debtor was say 25 days. Okay, and now it is increased in the next year. It is increased to say 35 days. So as per the standard, it should be coming under the stage two. So that means the lifetime PD you need to calculate. But here you can challenge this thing. Has not increased significantly since initial recognition, even though the contractual payments are more than 30 days past due. When an entity determines that there has been have been a significant increase in the credit risk before the contractual payment are more than 30 days, the rebuttable presumption does not apply. Okay, so here the entity can say like, okay, so even if it is less than 30 days, then also there is a significant increase. So there you can directly categorize under the stage 2. Okay, so in this case, the rebuttable presumption does not apply. So this is important, this one. So like here, the example is there have been a significant increase in the credit risk before the contractual payments are more than 30 days. So like from in the first year, DPD was 10 day, and then in the second year, the DPD was say 25 days. Okay, so this is the example here. So even if so entity determines that there have been a significant increase in the credit risk before the contractual payments. So here the entity can say that there is a significant increase in the SICR is there. Okay. So here the entity will not wait for the 30 days or more. And what is a credit impaired financial asset? This is that it is talking about the POKI. Like the banks, they are selling their NPA to the another bank, another entity. So for the other entity, this is the POKI. Purchased or the originally credit impaired. A financial asset is credit impaired when one or more events that have a detrimental impact on the estimated future cash flow of that financial asset have been occurred. Okay, the credit event has been occurred. Evidence that the financial asset is credit impaired include the observable data about the following event, the significant financial difficulty of the issuer. So now it is giving the example. So significant financial difficulty of the issuer, breach of the contract, then the lender of the borrower for the economic or the contractual reasons relating to the borrower's financial difficulty have granted to the borrower concession that the lender would not otherwise consider. Okay, renegotiation. It is becoming probable that the borrower will enter the bankruptcy. Okay, The disappearance of an active market for the financial asset because of financial difficulty. The purchase, this one, the purchase or the origination of the financial asset at a deep discount that reflects the incurred credit loss. Incurred. So incurred means where the event has already happened. Incurred. Yep. It is not expected here. So it may not be possible to identify a single. So it is saying that maybe it's a combination of the events here, all these combinations. So on that basis, you determine. So it may not be possible to identify a single discrete event. Instead, the combined effect of the several events may have caused the financial asset to become the credit impaired. Yep. Now it is talking about the measurement. So how the measurement will happen for the expected credit loss? An entity shall measure the expected credit loss of a financial instrument in a way that reflects an unbiased or the probability weighted amount that is determined by evaluating a range of the possible outcome, the time value of the money. So this all this we have covered, yeah. So PD it is talking about probability of default and time value of the money that the discounting is happening. So this also I have told you, and the reasonable and supportable information is available without the undue cost. Yeah. So when measuring the expected credit loss, an entity need not necessarily identify the every possible scenario. However, it shall consider the risk or the probability that a credit loss occurs by reflecting the possibility that the credit loss occurs and the possibility that no credit loss occurs. So it is talking about the PD, the scenario on the basis. So it's not required that you need to identify all the scenarios. You can identify some of the default events, and then you can see like what are the probability of occurring of that event. Yep. The maximum period to consider when measuring the expected credit loss is the maximum contractual period, including the extension option over which the entity is exposed to the creditors and not a longer period, even if that longer period is consistent with the business practice. Extension option, like means you have given the extension to the to the customer that okay you can exercise that option that like suppose you have given a loan to a customer for 5 years plus in that you have given an option that customer it can it can extend that loan period from the 5 years to say 7 years. So an entity may use the practical expedient when measuring the expected credit loss. Okay, so practical expedient is like your exception. So practical expedient means like you are taking the exception. So exception means like you're going for the simplified approach. So like instead of like uh, finding out the staging and then monitoring of the staging stage one, stage two, stage three. So then directly just for the simplicity, you can directly go for the stage three. But if you are going for the stage three, then it is coming at cost. Like you need to do, you should have the higher provision of it. Yep. An example of a practical expedient is the calculation of the expected credit losses of the trade receivable using a provision matrix. So this is a provision matrix like normally for the it is applicable for like portfolio you can say. Okay, for the portfolio instead of going for the PD into LGD into EAD, you can go for the provision matrix. So in the provision matrix, like whatever means you are analyzing your history, and on that basis you are arriving at the default rate, and that you are applying for the future. Okay, so you are not predicting the probability of default here. You are using the historical rate, historical uh, default rate here. So the entity would use its historical. So this is what they've said. The historical credit loss experience for the trade receivable to estimate the 12-month expected credit loss or the lifetime expected credit loss on the financial asset as relevant. So a provision matrix might, for example, specify the fixed provision rates depending on the number of the days that a trade receivable is past due. So again, it is talking about like on the basis of your history, then you are defining the default rate. So this is called as your provision matrix. So this is a simplified approach because you are not having a system to uh, determine the probability of default for the future. So you're using the past data instead of the future data. So for example, 1% if not past due, 2% if less than 30 days past due, and 3. So this is so on, like they have given the example. Okay, so it is saying that to have the 1% allowance if it is not past due, okay, and 2% if it is defaulted, means that the due date is crossed but it is less than your 30 days, so then the 2%. If you see the percentage, it is increasing 1%, 2%, 3%. So if the uh, the non means the DPD, if it is increasing, so then correspondingly this is also increasing. If you see this thing, the 3% if it is more than 30 days, okay, 20% if it is 90 to 180 days. So this is you have arrived on the basis of your historical data. So depending on the diversity of its customer base, the entity would use the appropriate grouping. Okay, if its historical credit loss experience shows a significantly different loss pattern for the different customers. So here it is talking about making the portfolio of the customer. So example of the criteria that might be used to group assets including the geographical region, the product type, the customer rating, collateral, other trade, credit, insurance, and the type of the customer. So like for the wholesale customer, you are having a one group. For the retail customer, you are having the another group. Yep. Wholesale means the loan which is given to the companies, and the retail where the loan is given to the individuals. Okay, so on the basis of this type of the customer, you can do the grouping. Okay, similarly on the basis of the geographical region also, like if it is given to the north, so then you can have this group, and similarly if you are given to the south, then this is a group. Yeah, so grouping, or maybe it depends on your country also. So now coming to the example, so now we are reaching to the last leg. So now it is the example here. So 12 months expected credit loss, the probability of the default approach. So here they are using the PD approach. Okay, so they are not using the your provision matrix. That is a historical data. They are not using it here. So entity A originates a single 10-year amortizing loan for CU 1 million. Okay, taking into consideration the expectation for the instruments with the similar credit risk, using the reasonable and the supportable information that is available without the undue cost or effort, the credit risk of the borrower and the economic outlook for the next 12 months. Okay, so entity A estimates that the loan at the initial recognition has a PD, probability of default, of 0.5%. So PD they have given, so PD into LGD into EAD, correct? Because they are using the probability of default approach. So it is 0.5% over the next 12 months. Over the next 12 months. So just try to see like how they have written. So here the chances of occurring of the default event which you have defined, the entity has defined the default events. Okay, so like for me, it is the downgrade of the credit rating. Okay, so the chances of occurring of that default event in the next 12 months. So that means 12 months ECL they are taking, not the lifetime ECL. Okay. Entity A also determines that the changes in the 12-month PD are a reasonable approximation of the changes in the lifetime PD for determining whether there has been a significant increase. So whatever the changes is, it is happening in the 12 months PD. So on that basis, you can determine that whether there is a significant increase in the credit risk. So this they have identified as a criteria. So loss given default is at 25%. So loss given default is your 25%. Calculate the loss allowance. So you are having a 1 million here. Okay, just simply you need to multiply it, then you will be getting the loss allowance. So here it is not talking about the interest, all those things. So directly it is talking about the your principal amount. so so at the reporting date, no change in the 12 months POD, and entity assesses that there is no significant increase in the credit risk since the initial recognition. So they are saying that, so this is the initial recognition. Okay, but they are talking about the subsequent, so at the reporting date here, so later on reporting date. So here, whatever the PD they have calculated, so it is on the basis of your 12 months, and now you are standing here. So now you need to see the 12-month PD here. Like, is there any significant change in it? 12-month PD. So this is the way means they are identifying the your SICR, significant increase in the creditors. So here, if it is say zero point 0.4, just I'm presuming they haven't given it, so it's a zero point 0.4, and now it is zero point 0.5. So if you see, there is not a big jump in the PD of the 12-month ACL. So that's why they are saying that there is no significant increase in the PD. Just see small things here. So it is talking about the reporting date. It is not talking about the initial recognition. Yep. So at the reporting date, no change in the 12-month period PD, probability of default, and entity assessed that there is no significant increase in the credit risk since the initial recognition. Therefore, the lifetime ECL is not recognized. Had there been this, it is jumped to say 10%. Okay, 0.4% PD to 10% PD of 12-month ECL. So then there is a significant increase in the credit risk. So then you will be moving to the second stage on this date. So then the higher PD will be coming. So here, then you will be calculating the lifetime PD, and that it will be more than 10%, say 20%. So low on this one, 25%, and this simply you need to just multiply it. Yeah, and you will be getting the 1250. So this is okay. Sorry, loss rate approach they are taking. So loss rate means they are not taking the PD approach. They are taking their historical this thing on the basis of the history. On on the basis of the past data, they are determining the default rate here. So now they are talking about the portfolio. So bank A originates 2,000 bullet loans with a total gross carrying amount of 5 lakh. Okay, 5 lakh. So that means the 2,000 loans are there. So each loan will be of uh, how much it will be? Uh, okay, it's not required here. Okay. So bank A segments its portfolio into the borrower groups X and Y. So this 2,000 loans X and Y. Okay, two groups they have made on the basis of shared credit risk characteristics at the initial recognition. Group X comprises 1,000 loan. So here the 1,000 loan, it is the number of loan. Okay. So then similarly here also 1,000 will be there because the total number of loans are 2,000. Okay. With the gross carrying amount per client of CU 200. So it is 200. So then it is coming 2 lakh. Okay. 2 lakh, and the group 5 comprises 1,000 loans with a gross carrying amount per client of 300. So it is coming 5 lakhs, which is matching with this one. Yeah, 5 lakh here. Okay. There are no transaction costs. This is for the simplicity. They've kept the example simple. And the loan contracts includes no options. So that is also like further leading to the complication. Like if there isn't some options are there, the prepayment option, then you need to calculate the exposure at default after considering all these options. So they have kept it simple. The premium or discounts are not there, point paid or other fees are not there. Okay, calculate the loss rate when. So when the historic per annum average default are 4 and the present value of the observed losses assumed are 600 and 450. Okay, so they have given the past data, that is the history, that in the history what they have seen that out of 1000 sorry, the historical that the per annum default is 4000 and the present value is 600. So this is the present value 600. So uh, So this is the case. You need to calculate the default rate. Correct. So four number of loans are defaulted. Defaulted. Okay. Four number of loans, and here it is two. And what its value? 600. It is the value 600, and this is a 450. Okay, 600 and the 450. So that means, um, and this is the PV, present value they are saying. Just say this one, the present value. So present value, so then if it is 200 each, if it is, so then it's, uh, what you say, the original amount should be, uh, 4 into 200, that is your 800, correct? And here also 200 into 300, that is 600. So after discounting this 800, it is becoming 600. Here also this 600, it is becoming 450. So this is 2 into 300, and this is 4 into 200 is equal to 800. Yeah. So this 600 and this 450, this you will be applying on this one. So 600 divided by 2 lakh. Similarly, 450 divided by your 3 lakh will be your default rate into 100. I think this is the way they have done it. Let check. Yeah, so 600 divided by 2 lakh, how much it is coming? 600 into 100 divided by 2 lakh. Yeah, so point 0.3 it is coming. And here it is coming 0.15. So this is your default rate. Default rate means your PD. Now, this is your PD. So this is they are calculating on the basis of their past data. So this is your, they have taken the practical expedient. That is the simplified approach they have taken. Okay, this you can read. Now they are talking about the lifetime expected credit loss. And here also they are using the provision matrix for the short term receivables. So they are using the practical expedient, the provision matrix they are using it. So the company, a manufacturer, has a portfolio of trade receivables of 30 million in 2001, and operates only in one geographical region. Okay, so this is a portfolio. The customer base consists of a large number of the small clients, and the trade receivables are categorized by the common risk characteristics that are the representative of the customer's ability to pay all the amount due in the contractual terms. So are categorized by the common risk characteristics that are the representative of the customer's ability to pay all the amounts due in accordance with the contractual terms. The trade receivables do not have a significant financing component. So significant financing component it is not there. So that means the present value concept is not there. Okay, so in accordance with the paragraph 5.15 of the Ind AS 109, the loss allowance for such trade receivable is always measured at an lifetime lifetime expected credit loss. So lifetime means your PD will be higher. Okay, and all these trade receivables are of the short period. This is also they have mentioned, I think somewhere, are categorized by this one. The trade receivables do not have a significant. Yeah, the short period. This one, correct. So that's why you're not having the significant financing. So please use the following information of the debtor outstanding. So the current it is 15 million. So and here it's a DPD 1 to 30 days DPD, 7.5 million, and here it is a 4 million, and this one. So and if you see the default rate, it is increasing. So because it is increasing for the current, so like simply just you need to multiply with 0.3% here. They have given the default rate. into 1.6 here, and there it is 3.6. Similarly here also it is like a 6.6, and here it's a 10.6. So default event, the default rate they have given it. So the example, in the previous example, the way they we have calculated the default rate. So now after calculating the default rate on the basis of the past data, then you need to just directly apply it on the your exposure. So this is your gross carrying amount. So here the PD LGD is not there. LGD is not there. Or maybe you can just presume simply that PD is your loss rate here, the default rate. Okay, default rate, and exposure is this one, and your LGD is your 100%. Then in in a way that you are applying this thing. If you don't want to think in this angle, then simply you can say that they have taken the practical experience, that is exception, for the simplified approach. Okay, and then just you need to total it. So in this way you are getting the provision amount, the loss allowance. Yep. So this is done, your uh, impairment one. But I think they haven't done the deep dive in the PD, LGD, EAD so much. The example which I have framed, so just refer to that also to have the more clarity about the concept. Yeah, the 12-month and the lifetime VCL, all those stuff. And this is a quick recap. So the classification and the measurement of the financial instruments are summarized as below. The basis of classification, this we have discussed in detail at length. Okay, so amortized cost, like when it will be amortized cost when you are having a business model, that you are passing that business model of CCF, and plus the SPPI test are there, both are passed. Okay, and for the FVTOCI, you are having your business model is to collect the CCF plus your HFS, and then SPPI test is passing, and then otherwise the remaining one is FVTPL. And in the financial liability, you are having a default, it is the amortized cost, and if you are just using it for the trading purpose, then FVTPL, or the entity elects the FVTPL using the fair value option, that is accounting mismatch, or the portfolio performance. So in those cases, you are designating it to the FVTPL. This one. Okay, so this is the straightforward initial recognition, that you are deducting the transaction cost. Sorry, you are adding the transaction cost because it's a financial asset, and similarly for this one, the financial liability, for the amortized cost, you are deducting it. Yeah, and in the FATP, the transaction cost, you are transferring it to the P&L. And for the equity also, you are transferring the transaction cost to the equity. And in the FVOC, you are transferring, you are adding for the financial asset. Yeah. Then amortized cost, fair value, fair value. So this we have discussed in detail. So ah, I hope now, Miss, you must be comfortable in the second chapter, because we have discussed at length, line by line, about this chapter. Uh, so I need your feedback. Like, Miss, are you uh, liking the way in which I'm explaining it to you? Uh, First, I'm explaining my concept, and then we are reading the material and then explaining it. Yep. And if you're liking it, then please subscribe it, and circulate it among your friends. Okay. Thank you.